everyone, and welcome to today's episode of Macro Microscope in September 2025. I am Indrani, Head of Global Investment Research in FTSE Russell, the index business of the London Stock Exchange Group, and I'm joined by John Dioufas, Director, Data Stream and Macroeconomics, London Stock Exchange Group. Today's topic will be reversal of fortunes, Northern versus Southern Europe. And those of you who have listened to my presentations will know that, I've often talked about that the world is in the midst of structural changes, which is why markets and economies are behaving in ways very different from what we got used to for a long time between the great financial crisis and the years of COVID or just after. So the reversal of fortunes, Northern versus Southern Europe, is another one in that broader theme. Now, let's jump into it with a quick disclaimer. Obviously, FTSE Russell is not an investment advisor, and everything said here is purely for educational purposes. Now, it's important to define, what do I mean by Northern Europe? It's Germany, France, Netherlands, the traditional economic powerhouses and the economic strength of Europe. What do I mean by South? Italy, Spain, Greece, and Portugal. So the first chart I'm going to show on the right-hand side, look at the dark purple line for Italy and the gray line for Spain, and it shows their sovereign yields in the 7 to 10 year space against France's 7 to 10 year. And what do you see? It's a very sharp compression in Italian and Spanish long yields relative to France. And I'm going to argue that it's coming from a place of fiscal policy divergence, because we are in a world where there's a shift away from fiscal orthodoxy in Germany. In France, we have seen so many governments fall because of tensions about getting the fiscal space and order. Italy, on the other hand, has followed a completely different path. They have been dramatically reducing their fiscal deficit to GDP ratio from north of 7 percentage point in 2023, and they are targeting less than 3% in 2026. In 2024, it was barely north of 3 percentage points. So that's some dramatic shift that you're seeing playing out in the sovereign rates space. And again, let's do the same analysis relative to Germany. Now, again, Italy in dark purple and Spain in gray, they're 7 to 10 year relative to Germany. You see the same compression now down to about 50 basis points, whereas see how high those spreads were as recently as 2018 and 19. On the right-hand side, you see the same thing with Greece and Portugal. They're 7 to 10 year relative to Germany. Same story, very sharp compression. Here we are showing everything relative to the 7 to 10 year, but the story remains the same even at the really long 20 plus year tenor. Another thing that I'm going to talk about is the slope of the yield curve, because many developed markets have seen a steepening in their yield curve because the long ends are picking up concerns about their fiscal situation, so to say. So this is the slope of the yield curve, the 20 year plus yield relative to the 1 to 3 year. Again, you see for Spain and Italy, the lines in the light gray kind of thing. The slope of the Italian and the Spanish yield curve, pretty much the same slope as the French curve. The point being, markets are looking at them as if they have the same risk. And again, I think this is because of fiscal policy, because all these countries have the same ECB monetary policy. Now, why are these things happening in the sovereign rate space? Because what happens there picks up what's happening in the underlying macro economies. So look at the chart on the right-hand side. The bars are in purple for Northern Europe, in gray for Southern Europe, and it's showing the changes in key economic indicators between 2022 and 2025, so last 3 odd years. And we have highlighted some of the most important indicators. Look at what is happening in unemployment, dramatically down in the south, up in the north. What's happening in industrial production or electricity production, which is a forward-looking indicator for economic growth, down in the north, up in the south. Essentially, it's Southern Europe, Spain, Italy, Portugal, Greece. They are having stronger growth, better employment picture, better fiscal situation, at least in terms of improvements for sure, and their exports going up, economic strength. Now, this is also showing up now in the equity markets. The chart on the left, you see for the various Northern and Southern European countries and also for the US. In purple is the 3 year annualized equity returns. in gray are the 10-year annualized equity returns. Which are the countries with the tallest bars in purple? It is Greece, it's Italy, it's Spain. And they are much higher 3-year annualized return than those of France and Germany, and for that matter, even the United States. And also for these countries, the purple bars, 3-year returns annualized, are so much higher than their 10-year annualized returns. Things have really changed on their equity front in the last 3 years. And returns are not everything. It always has to be seen in the context of risk-adjusted returns. So the right side, you see a scatter plot where the returns are on the y-axis and the volatility is on the x-axis. And what do you see? You see Italy and Spain, obviously, with the same highest total, return. But what's very interesting is their volatility is in the same ballpark as for the Nordic countries and Germany and France, meaning not only are they giving higher equity returns, they are giving higher equity returns for pretty much the same amount of volatility, meaning distinctly higher return per unit of risk. With that, I'm going to turn it over to John.
Thank you, Indrani. And yes, I want to look at everything that you've just spoken about at quite a high macro level, try to get a feel for the macro environment. And we're looking here at the central bank policy environment. Within LSEG, we have our interest rate probabilities model. It tracks 22 central banks, trying to figure out what their next policy move is going to be based on how the market is pricing the underlying curve. And we can see that of those 22 central banks, 14 are scheduled to not change their rates at all at the next policy meeting, and 8 are scheduled to cut their rates. Now, that really speaks to an environment where pretty much the market is pricing in a control of inflation. It feels like high central bank rates are a thing of the past for us, at least for the foreseeable future. When I go to the next slide, what I'm actually looking at here is I can do a bit of analysis of where the policy rates are and also what consumer inflation looks like. So the chart on the left is the policy rates for the G7 countries. And you can see there that of the 5 central banks within the G7 space, only the ECB has moved its policy rate down to its inflation target. So the ECB feels like it has inflation pretty much under control. Take Japan aside, they've got to unwind years, multi-decades worth of monetary easing. You can basically see that Canada, the US, and the UK still have to take their rates down a little bit to get towards their more neutral rate. On the right-hand side, when we look at consumer inflation, we're doing it for the larger European economies. And we can actually see that of all the European economies, France has the lowest inflation growth rate for consumer inflation. So from an inflation perspective, France is in pretty good shape. We also want to look at how the market is pricing in risk. We're going to use the gold to silver ratio as a proxy for this. And we see that is actually on its way down. It's currently trading at about 85.47. It's heading towards its long-term average of 67.82, but sharply down from its previous high of 99.23. So even from a perspective of the market pricing risk, it feels like everything's sort of heading in a positive direction. It's the next chart that really gives us an idea as to why it is that the yields for France are really tracking up. What we can see is out of all the European countries, France has the highest total debt. And it's also got the third highest debt to GDP ratio. So, I think the market is, as Indrani said, reinforces what Indrani said. It feels like the market is saying to the French government, you need to implement reforms. But the challenge that the French have is that they're constantly having to sort of reform their governments due to the high unpopularity or the high levels of unpopular decisions that they got to make, right? So that is a real challenge that they're facing. And I just want to call out that the United Kingdom at the moment has the third highest total debt, and it's quite high at the debt to GDP ratio. So where France is now, if things don't go according to plan for the UK, we might be seeing a similar situation. So thank you very much, everyone. Really appreciate your time. Bye-bye.
Thank you. Bye now.